for joining us today on this edition of Business Daily. I'm Lee Ji-yoon. Let's get started by taking a look at today's highlights. The number of people jobless for more than 6 months grew at the fastest pace on record last month amid concerns of prolonged low growth. As the U.S. Fed Reserve sits down for its monetary policy meeting, we take a look at the chances of seeing a rate hike this month and how the Bank of Japan's revised easing policies will affect others. The number of long-term unemployed, those out of jobs for over half a year, is on a sharp rise here in Korea, further stoking concerns that the country is falling into a prolonged period of weak growth. Our Hwang Ji-hye starts us off.
Data from Statistics Korea shows the number of people unemployed for more than 6 months stood at 182,000 last month, up 62,000 from a year earlier. That marks the fastest on-year rise since June 1999, when records based on revised standards were first compiled. The number of those facing long-term unemployment has risen by 10 to 20,000 every month on average since 2014. But the pace has shot up since July this year, when the figure jumped by 51,000. The ratio of those without jobs for over half a year out of the overall number of unemployed is also rising fast. The figure came in at over 18% last month, the highest since late 1999, when Korea was struggling to get back on its feet after the 1997 Asian financial crisis. While short-term unemployment is considered a natural economic phenomenon, experts say long-term jobless trends signal the domestic economy may be in a prolonged period of sluggish growth. Still, experts say there is a silver lining on the domestic front.
The construction sector is likely to shore up domestic demand through the second half of this year, so overall growth in the economy won't be that bad.
But concerns about massive long-term unemployment are piling up as the government pushes to overhaul struggling corporate sectors. The restructuring of ailing shipbuilding and shipping firms has already resulted in soaring jobless rates in the country's southern regions, where shipyards and ports are concentrated. Experts say in times of slow growth, those layoffs could end up exacerbating the problem of long-term unemployment. Hwang Ji-hye, Business Daily.
Korea's producer price index made a slight gain last month, largely due to an extensive summer heat wave. The Bank of Korea said Wednesday that the index rose an estimated 0.1% in August from the month before, returning to positive growth after dipping in July. The central bank says soaring temperatures in August hurt production and agricultural foods, crimping supply and pushing up prices by over 13.8%. Cabbage prices shot up 123%, while spinach prices rose by 215%. Coal and petroleum products did not fare as well, falling 4.5%, and chemical and electric goods inched down by 0.3%. In terms of on-year performance, the index dropped by 1.7%. Korea's ban on using the Samsung Galaxy Note 7 on aircraft will no longer be applied to devices that have been replaced for new ones. The Transport Ministry sent out a notice to airlines as well as airport officials, saying the replacement devices can be used, charged, or stowed. Samsung Electronics is offering exchanges of Note 7s this week in 5 countries, including Korea, Singapore, and Canada, after it announced a global recall following reports of devices catching fire while charging. Major airlines had warned passengers to turn off their Note 7s and refrain from plugging them in. The ban still applies to Note 7s that have not been replaced. An advanced battery for electric vehicles may be released in 4 years from now, allowing users to travel across the country from Seoul to Busan on a single charge. According to the Ministry of Trade, Industry and Energy, it has partnered up with 27 entities, including Hyundai Motor and LG Chem, to produce a battery with high energy density that can power a vehicle for 400 kilometers per charge by 2020. Now, that's expected to be a significant upgrade from the battery installed in Hyundai's Ioniq Electric, which has a maximum range of 190 kilometers. A total of $38 million will be invested in the project, with the government shouldering about $24 million. Yesterday, we discussed a troubling trend of skyrocketing household debt, driven up particularly by aggressive real estate investments. And in the second of our three-part series today, we take a look at government policies working to stem this rising tide. Our Eunice Kim tells us more.
It's a strategy that worked all too well. The government's move to boost the economy by stoking the public's appetite for investment in real estate was received with great enthusiasm. It also drove up the country's household debt burden to new heights. As of the end of June, it sat at $1.12 trillion.
We will oversee the process by reducing residential land supply and requiring a stricter review.
With aggressive borrowing continuing through the summer months, the government unveiled its August 25th plan that it said would help cool hot demand in residential real estate by limiting their supply. But investor reaction was exactly the opposite. Thinking a controlled supply would be a boon to returns, Koreans looking to grow their money stepped up their purchases, with a special focus on older buildings tagged for reconstruction in the lucrative Gangnam neighborhoods. Meanwhile, as hot sections of Seoul saw their value jump by 6 figures in a matter of months, real estate prices in the country's southwest and cities like Daegu and Ulsan instead plummeted. In early September, Korea's top financial regulator, FSC Chairman Im Jong-yong, said efforts would be made to roll out the August 25th measures earlier than planned in reaction to the rising household debt. It would aim to implement tougher screening of loan repayment abilities within this year, pulled up from 2017. The debt service ratio would replace the current debt-to-income ratio formula, adding the element of loan principal to interest on existing liabilities. It'll also add existing credit card debt to the evaluation. And it will become more difficult for those with collective midterm payments or overdraft loans under their belts to win new loans. Nonetheless, skepticism remains.
The government knows it needs to hold down household debt, but it doesn't want to abruptly burst a housing bubble.
The government's proactive posture shows that the problem demands close attention. But as regulations lack stronger and bolder moves, many are not expecting a fundamental impact on curbing the growing debt pile. Eunice Kim, Business Daily.
Japan's central bank today decided to keep its rates steady, but announced a number of changes to its monetary policy approach. This as the U.S. Fed Reserve is set to sit down for day 2 at its FOMC meeting. And all eyes are on the Fed as officials have been split in recent weeks over the timing for a rate hike. To tell us more about this, Professor Kim Young-han from 성균관대 University joins us in the studio today. So good to see you.
Pleasure to be here.
All right, so first, can you tell us more about what came out of the Bank of Japan today and what we can make out of its policy decisions? I mean, they called it a new framework for strengthening monetary easing.
Right. I would say the latest kind of their decision simply reflects the really chronic Japanese economic performance, and their GDP growth rate has went back to zero rate, and in the first quarter of this year, their growth rate has gone up 0.5%.
Okay.
But again, it has gone to 0% growth rate. And also their inflation rate shows a serious disinflation, trends of disinflation. And the latest data shows that the consumer price index has gone down minus 0.4%.
Okay.
So all these data shows that they have to take every action to boost up their economies. And in that context, I would say this type of the expansionary policy was somewhat expected policies.
All right, then let's turn our eyes to the U.S. Fed. Is there a chance that the Bank of Japan's decision today will affect the timing of a U.S. rate hike? I mean, can we expect the Fed to raise rates this month?
Well, definitely U.S. Policy will be affected by kind of latest Japanese actions. And they should keep at least a minimum coordination in terms of monetary policies. And especially, as you suggested, when you look at the details of the macroeconomic performance of the U.S. economy, is the same quite miserable performance. No. Yeah.
Oh dear.
Yeah. Well, Japanese, U.S. economy has taken what they can do, but still, well, their GDP growth rate still remains at the level of 1.1%, much lower than their expectation. And also the consumer price index shows just 0.8%, far below their target rate. They had targeted to reach at least 2% as so-called normal types of inflationary trends. And also, when you look at the unemployment rate, the number itself shows something good. Current unemployment rate remains somewhere around 4.9%, quite similar, close to the so-called full employment rate. But when you look at the details of the structure, so-called part-time employment takes the real big shares, and the share of the part-time employment is a kind of increasing steadily. So we cannot really observe any inflationary pressure from the labor market. Considering all these kind of trends and data, there is no reason, I would say, for Feds to rush to increase their interest rate.
So many are actually expecting this rate hike to come in December, right? So what are your thoughts on this? And also, what are some things that we should keep our eyes on from this week's FOMC meeting?
I would say the decision in December will depend on their estimation of first macroeconomic performance, and also the more deep-rooted kind of argument for interest rate hike is just current supply of liquidity is simply too much. They estimated current level of liquidity is way high than the normal state, mainly due to the so-called helicopter money drop during the last almost 8 years.
Wow.
During the quantitative easing. So they are quite worried about possible asset price bubble and speculative bubbles also in housing market. So I would say if they can figure out any kind of concrete sign for the asset price bubble, including housing market, and also if they can observe some increasing trends of the inflationary pressure from labor market, it is highly likely for the U.S. Fed to take some action to increase interest rate. But still, I would say if they still face some staggering kind of economic performance, then I would say still, once again, they might take quite a cautious approach. So we cannot say for sure what kind of action we can expect for now.
Now, like I mentioned earlier, Fed officials have confused markets with conflicting comments about the U.S. rate hike and its timing, and some have actually said that have resulted in loss of credibility for the U.S. Fed and its comments.
Well, but however, yeah, it's understandable that the market has overreacted and quite confused with the kind of conflicting kind of message from the Fed. But see, it reflects that kind of complicated situation Fed is facing. That is, where we can agree that current status of monetary policy is not normal in terms of the policy tools taken, including the quantitative easing. That's not a normal type kind of monetary policy which we can read from textbook. All the measures taken lately is something out of textbook. So some kind of emergency actions has been kept on being taken. So our argument is we should go back to a normal track.
Okay.
So in that context, they are arguing for some kind of contractionary actions. But still, when you look at the market itself, no real positive sign for recovery. So I would understand Fed has two conflicting kind of policy aim. They should go back to a normal track, but still when they consider the market, it's not the proper time for them to take a contractionary policy. So real problem is, I would say, too sensitive reaction from speculative kind of capitals, expecting the agglomerations, all those what speculative trends, I think they are actually boosting up overreaction in the market. So I would say it would be somewhat important for the policymakers to make a coordination to reduce those negative impact from those too sensitive speculative capitals.
So if the Fed raises rates in September or in December, how would all that, the Fed pulling the trigger, affect emerging markets as well as Korea?
Well, we have actually repeatedly kind of experienced all negative and too sensitive overreaction, especially in emerging market, mainly driven again by the speculative capitals. So, but still, I would say the real impact, what we can be worried, would be a somewhat short-term impact on financial market, mainly driven by the leading market power of the speculative capitals. Otherwise, I would say more stable, consistent policy by emerging economy would be more important than too sensitive reaction to the Fed's actions.
All right, we'll definitely keep an eye on what comes out of the meeting, I guess, this week. Thank you so much for coming in today.
Yeah, my pleasure. Yeah.
And that wraps it up for today. Thanks so much for watching. We'll be back tomorrow with more business news that matters to you. Until then, goodbye.